With all the economic uncertainty right now, where's the best place to invest your money? And let's just assume that the stock market is still a little too scary. So what else is safe? Is there anything wrong with sticking your money in the bank and keeping it in certificates of deposit? Not at all, but keep in mind, like any investment, there's upside and downside.
The upside to CDs is they're guaranteed. They pay a fixed interest rate for a specified period, let's say 3% for 12 months. $5,000 in a CD with those terms would earn about $150, giving you $5,150 after a year. Not a great return, but better than losing money. Oh, and did I mention they're FDIC insured? That means if the bank fails, the government makes good on your deposits up to $250,000.
In the past, that didn't seem like such a big deal. It's a really big deal now. Now, what about putting your money in money market accounts from your local bank or savings and loan?
Money market accounts, or MMAs, are also FDIC insured, but they're not to be confused with money market funds. We'll get to that in a minute. MMAs, or money market accounts, usually pay less interest than CDs, but they have the advantage that you have access to the money. Banks usually allow you 3 to 6 withdrawals a month. If you think you're going to need some cash from time to time and don't want to lock up your money for 6 months to a year, an MMA may be a better bet.
Now, what about those money market funds that we mentioned earlier? They're not FDIC insured. And here's how they differ from a money market account.
Money market funds are mutual funds that typically invest in high-quality short-term investments that mature in 13 months or less. Fund investments can include U.S. Treasury securities, CDs, federal agency notes, commercial paper, and municipal securities. Money market mutual funds base their annual rate of return on the yield the fund has earned over a 7-day period. Fund managers try to maintain a share price of about $1. The share price is known as net asset value, or NAV. These funds have generally been considered less risky until the current financial crunch, when liquidity issues began to affect some fund values.
What about government-issued bond funds? They seem pretty safe.
In fact, funds that invest in government debt are considered to be among the safest investments because the securities are backed by the full faith and credit of the U.S. government. However, like other mutual funds, the fund itself is not government-backed and is subject to risk in the event of interest rate changes. If interest rates rise, bond prices decline. And if interest rates decline, bond prices go up. Interest rate risk is greater for long-term bonds.
So there are some low-risk alternatives to keeping your money in your mattress, but it all depends on how much risk you're willing to take on. For ConsumerAffairs.com, I'm Mark Huffman.